The Wall Street Journal. When President Trump announced his Liberation Day tariffs in April, a group of economists regularly surveyed by the Wall Street Journal cut their growth forecast for 22,000 from over 2% to 0.8%. They were terrified. They believed the tariffs would crater the economy. They believed it would be a repeat of the tariff disasters of the past. They believed it would choke off growth, spark inflation, and send the U.S. into a hard landing. And then none of that happened. Growth came in at 2.3%. Inflation ended at 2.7%, well below the 3.6% feared at the height of tariff fears. Unemployment ticked up to 4.4%, but it wasn't a catastrophe. The economy continued to grow. Consumers continued to spend. The thing that was supposed to destroy everything didn't, so the same economists revised their forecasts back up. For 2026, they started with 2.1%. In April, they cut it to 1.8%. Now they're back to 2.2%. They're essentially back to where they were before the tariff announcement. This is the story from the Wall Street Journal. But it's not really a story about economics. It's a story about what happens when the consensus is wrong and reality forces a recalibration. And most importantly, it's a story about what's actually hiding underneath the good news. Let me start with the core narrative. Economists were terrified of tariffs. They built models. They extrapolated from history. They assumed that massive tariff increases at the pace of the 1930s would produce 1930s-like effects. And the data did not cooperate. KPMG's chief economist Diane Swonk put it this way: the effective tariff rate will likely peak a little above 13% in the first quarter, and that's almost half the pace of April 2nd. But it's still more than 4 times the pace of a year ago. It wasn't as bad as it could have been. It wasn't as bad as it could have been. That's the summary. The tariffs were bad relative to the Trump administration's promises to make prices fall, but they were less bad than the worst-case scenario. And that less bad was enough to surprise economists who had priced in catastrophe. Now, here's the data on screen. You're looking at consumer price changes for select categories in December. Overall inflation, plus 2.7%. That's the headline number. Below that, you see eggs minus 20.9%, gasoline minus 3.4%. Those are the stories people see. They see eggs crashed because of bird flu. They see gas dropped. They see some relief. But scroll down, coffee, plus 19.8%. Beef and veal, plus 16.4%. Furniture and bedding, plus 3.6%. Vehicle parts, plus 3.4%. Apparel, only plus 0.6%, but that's because retailers absorbed the tariff cost instead of passing it to consumers. So the picture is this. In categories where tariffs directly apply, furniture, vehicle parts, audio equipment, prices went up. In categories where retailers have margin to absorb costs, apparel, toys, cars, prices barely budged. And in categories exposed to supply shocks, coffee, beef prices exploded. On screen, imagine 2 bars side by side, one labeled tariffed categories, showing mostly moderate increases, one labeled supply shock categories, showing dramatic increases. The overall inflation number averages them together into something that looks moderate. But here's the uncomfortable truth. Most of the tariff impact on prices is still in the future. Research from the Kiel Institute for the World Economy found something stark. By analyzing $4 trillion of shipments between January 2024 and November 2025, they discovered that foreign exporters absorbed only about 4% of the burden of last year's tariff increases by lowering their prices. American consumers and importers absorbed 96%. The study said it clearly. Rather than acting as a tax on foreign producers, the tariffs functioned as a consumption tax on Americans. Julian Hinz, one of the researchers, said, "There is no such thing as foreigners transferring wealth to the U.S. in the form of tariffs." The $200 billion in additional U.S. tariff revenue last year was paid almost exclusively by Americans. This is the inflation number that's not showing up yet, because retailers have been absorbing tariff costs, because importers have been eating margin, because the supply chains have been adjusting slowly. But as those adjustments complete, as retailers stop absorbing, the tariff inflation will show up. Now let's talk about the other half of the picture, the job market. The one part of the economy that fared poorly last year was jobs. Monthly job growth averaged 49,000, down from 168,000 in 2024. The unemployment rate rose to 4.4% in December 2025 from 4.1% a year earlier. That's not an enormous jump, but it's the trajectory that matters. It's moving in the wrong direction while growth is supposedly resilient. Why? Cost-conscious businesses turned hesitant about adding workers due to tariff uncertainties. They used artificial intelligence to drive productivity instead of hiring. There was a crackdown on immigration, and retirements dented the worker supply. This is the Achilles heel of the economic story. Growth is resilient, yes. Upper-income households are spending because the stock market is up. Tax cuts from the One Big Beautiful Bill Act will give refunds and boost consumer spending in spring. But the job market is weak. Economists expect the unemployment rate to hover around 4.5% in 2026. They expect monthly job growth to average 65,000 next year, up from 49,000 this year. But that's still significantly below the pre-pandemic normal of 200,000 plus. It's still consistent with a labor market that's gradually weakening, not tightening. So, the economic story is, growth is okay because upper-income consumers are spending. Middle and lower-income consumers are being squeezed on prices. Eggs down, but coffee up 20%, beef up 16%. Groceries remain expensive. And job creation is weak, which means the income side of the equation is not supporting the consumption side long-term. This is not a catastrophic story. It's not a recession story yet. Economists only assign a 27% probability to recession in the next 12 months, the lowest in a year. But it's a story where the consensus has gotten ahead of the reality. Now let's talk about capital allocation and the tariff logic. When Trump announced tariffs, the logic was tariffs are paid by foreigners. Foreigners will cut prices to maintain market share. American consumers will not be hurt. The tariffs will function as a subsidy to American producers. The Kiel research demolished that narrative. It showed that foreign exporters held price firm. They did not cut prices. In some cases, Indian exporters, for example, they maintained prices but reduced volume shipped to the U.S. by 18 to 24%, relative to sales to the EU, Canada, and Australia. Why? The researchers suggest the exporters might have found buyers in other countries. They might think tariff levels will change and are maintaining price in the meantime. The scale of tariffs, 50% or more in places, makes it better not to sell at all than to sell at tariff-compressed margins. And U.S. importers have long-term relationships with suppliers they can't instantly change. So the capital allocation failure is this. Trump believed tariffs would shift the cost burden to foreigners. Instead, tariffs shifted the cost burden to American consumers and importers. The tariffs did not function as the president intended, and the adjustment of prices to reflect that reality is still ongoing. This is the hidden inflation risk. As importers can no longer absorb tariff costs, as retailers can no longer sustain lower margins, prices for tariffed goods will rise. That price rise might offset the gains from falling egg prices and falling gasoline. Now let's look at what's changing in the forward view. Economists expect Fed Chair Jerome Powell's term to end in May. Trump has said he expects to nominate someone who will cut rates significantly. The current Fed has already cut rates 3 times to between 3.5 and 3.75%. Economists expect 2 more quarter-point cuts by the end of 2026, bringing the midpoint of the federal funds rate to around 3%. But here's the tension. If inflation is still above target and jobs are weak, the Fed might not have room to cut. Or the Fed might be forced to cut despite inflation concerns because political pressure demands it. This is the inflection point the article hints at. Jerome Powell fought the pressure to cut rates regardless of inflation. The next chair might not have that fortitude. This matters because it changes capital allocation decisions. If the Fed becomes dovish regardless of inflation, long-term real rates become negative. That favors equities and borrowing. It disfavors savers and bondholders. It accelerates the bifurcation we saw in 2025. Upper-income households with assets? Up. Lower-income households with income? Squeezed. Now, let me extract the 3 timeless lessons here. First lesson. Consensus forecasts are most dangerous when they move sharply. When economists cut growth forecasts from 2% to 0.8%, they're saying they have high conviction in a catastrophe. When that catastrophe doesn't materialize, They look foolish and they reverse the forecast. The problem is that the sharp reversal suggests they didn't have a deep understanding of what would actually happen. They extrapolated from fear, not analysis. Second lesson: inflation can hide in plain sight. The headline inflation number of 2.7% looks moderate, but it's an average. Eggs are down 21%, but beef is up 16%. Coffee is up 20%. Subscription services are up 29%. Netflix, Peacock, Apple TV all raised prices. The distribution of inflation is wildly uneven. And the distribution that hurts most? Food prices, housing prices, subscription services that people depend on, is getting worse. A 2.7% headline number could mask much higher real inflation for people who spend most of their income on necessities. Third lesson: tariffs don't work the way policymakers think they work. The assumption was that tariffs would tax foreigners and protect American workers. The reality is that tariffs tax American consumers and importers. Foreign producers don't have the same incentive structure to absorb tariff costs. They can sell elsewhere, they can reduce volume, they can absorb margin loss. The policy outcome depends entirely on elastic demand and inelastic foreign supply. Neither condition exists in most tariff scenarios. Now, here's the broader conviction. The consensus economic forecast for 2026 is 2.2% growth, 2.6% inflation by year-end, unemployment around 4.5%, and a dovish Fed. That's a soft landing scenario. It's what the market is pricing. It's what investors are betting on. But that scenario requires several things to go right. Upper-income consumers continue to spend because stock markets stay elevated. Tariff prices don't crater margins further in 2000. The job market stabilizes without recession. The Fed has room to cut rates while inflation is still above 2%. Geopolitical risk, the fight over Fed independence, tensions with Europe over Greenland doesn't materialize into real economic damage. Those are a lot of assumptions, and when one of them breaks, the consensus reverses sharply, just like it did in April. The real risk is not that growth will be zero. The real risk is that the consensus has gotten too comfortable, too aligned, too dependent on upper-income consumer resilience and stock market elevation. The moment any of those props starts to wobble, the forecast gets cut again. And this time, the market might not be as forgiving. The one thing to remember from this entire data story is this. When economists are surprised to the upside, it's usually because the consensus had already priced in a downside. And when they get surprised to the downside, it's usually because the consensus had gotten too comfortable. We're in a moment where the consensus is comfortable. And comfort is usually when the risk is greatest. Justin Johnson is 47 years old. He lost his $130,000 job as a software project manager when a government contract ended. He has applied to 100 or more desk jobs without luck. And when confronted with the possibility of switching to blue-collar work, becoming a journeyman electrician, for example, he said this: "That would be very difficult to do because I'm the breadwinner in the household, and you get accustomed to a certain lifestyle." That sentence contains everything you need to understand about why the American labor market is fragmenting, why smart people are making worse decisions than they think, and why capital allocation, the allocation of your own human capital and time, is being driven by cognitive biases rather than rational economic analysis. The Wall Street Journal published a piece about white-collar workers and blue-collar career transitions. The headline is innocent enough: white-collar workers shouldn't dismiss a blue-collar career shift. But the real story underneath is about sunk costs, status anxiety, and how a generation of well-educated workers is being displaced by AI and cost-cutting while leaving money on the table by refusing to adapt. Let me start with the macro pattern, because it's the most important. Layoffs and stagnant wages have a lot of white-collar workers feeling stuck. We're talking about people in tech, finance, media, marketing. These were the categories that compounded wealth for 30 years. These are the industries where a college degree plus a few years of experience meant you were set. You had optionality. You had upward mobility. And now? Those workers are applying to 100 jobs with no bites. Meanwhile, blue-collar industries face a labor shortage. Construction, security, auto repair, these sectors are desperate for workers and willing to pay good money to get them. Here's the data that should alarm anyone who bet their career on the white-collar premium. The share of workers in their early 20s who are employed in blue-collar roles rose to 18.4% in 2024 from 16.3% in 2019. That's a 20% increase in blue-collar employment among Gen Z in just 5 years. And here's the kicker. That uptick was 5 times larger than the uptick among 35 to 39-year-old workers. In other words, Gen Z is choosing blue-collar careers at 5 times the rate of millennials. This is not a random labor market shuffle. This is a generational decision to reject the college debt premium. Why? The article gives 2 reasons. Gen Z is wary of college debt, and Gen Z is afraid that AI will replace entry-level office jobs. They watched their older siblings graduate with debt and no jobs. They watched white-collar industries get disrupted, and they decided, I'll learn a trade. This is the most rational response to a changing labor market. And it's exactly the response that older, already debt-laden white-collar workers should consider but don't. Now, let's talk about the 3 companies and the operators who have figured out how to profit from this labor market gap. First, Crash Champions, a car repair chain with about 650 shops in 38 states. The company is hungry for service advisors. This is not a mechanic position. You don't sweat under the hood. You assess damage, estimate the cost to fix it, and oversee the process. You need to know a lot about cars, but you don't need to get your hands dirty. For people who don't have car knowledge, there's a 6-month apprenticeship program. The starting salary is roughly $60,000. Now, for a white-collar worker making $130,000, that sounds like failure. That sounds like admitting defeat. But Matt Ebert, the CEO, says service advisors can double their salaries in 18 months. They can reach $200,000 a year in a matter of years, not decades. From there, they become general managers of shops, then directors in charge of multiple locations. How is this possible? Because Crash Champions is among a slew of blue-collar businesses to attract private equity investments in recent years. A company that had 13 locations in 2019 is now at 650. When a company is growing at that velocity, people get promoted quickly. The organizational structure is stretching. You need management. You need operators. And the person who just learned the business has an advantage over the old-timer who's been doing the same job for 20 years. This is the inflection point. Private equity is taking blue-collar businesses and scaling them like tech startups. That creates opportunity velocity that didn't exist before. The second company is Power Home Remodeling. Asher Raphael is the co-CEO. He joined the company 23 years ago when he had no other job offers after college. He was supposed to stay a year before going to law school. He's still there. The company is now private equity backed. It has 4,700 employees and $1.73 billion of revenue last year. That's a $4.7 billion company in the home remodeling space. And the reason it succeeded, Raphael says, is that it avoided the things customers hate about contractors: poor communication, inability to stick to deadlines or budgets, lack of professionalism. So the company started hiring professional people. They took someone who worked in tech sales, earning $85,000 to $100,000 a year, and offered them a lateral move into home remodeling. A 10-week craftsmanship academy brings new hires up to speed. And suddenly, that person has a floor knowledge of the business and the professional standards of someone from tech sales. That's a combination most traditional contractors don't have. Why does this matter? Because it's the opposite of what most people think about career capital. People think, I need to go deeper in my field. I need to specialize. I need to become more valuable within my industry. But Raphael discovered something different. Professional skills, communication, project management, budgeting, customer service are more transferable across industries than specific technical knowledge. A person who spent 5 years managing software projects can learn home remodeling faster than a person who knows everything about home remodeling but has never managed a customer expectation in their life. The third company is Specialized, a security firm where CEO Vince Caraba, who dropped out of college, says something that should shake the entire credential-obsessed economy. I hate using white-collar and blue-collar. What will those terms even mean in 5 years? Getting to management at Specialized requires at least a brief stint as a frontline security officer. Typical starting pay for unarmed guards is $20 to $25 an hour. But people who make it to management and executive roles earn $100,000 to $500,000 a year. The point Caraba is making is that the distinction between white-collar and blue-collar is already blurry. A construction company employee who moves into sales, a car repair service advisor whose principal tool is a tablet, not a wrench. These people aren't blue-collar in any traditional sense. They're operators in a business that happens to involve physical output. Now, let's talk about the sunk cost fallacy that keeps people from making better decisions. Amy Glazer is a senior vice president of business operations at the recruiting firm Adecco. She describes what's happening in white-collar workers' heads. After shelling out for college and amassing years of experience, it is natural to fixate on jobs in your one field to justify those investments. This is textbook sunk costs thinking. You spent $100,000 on college. You spent 5 years building expertise in software project management. And now, because you've made those investments, you're convinced you have to make them count by continuing to work in that field, even if the field is offering you nothing. But that's not how capital allocation works. Sunk costs are sunk. They're gone. The only question that matters is, what's the return on my marginal capital, my next 5 years of work, if I stay in this field versus switching? For Justin Johnson, the answer is clear. If he stays in software project management, he has no job offers. Zero return. If he switches to blue-collar work, he starts at $60,000 and can reach $200,000. That's a positive return. The fact that he got accustomed to a certain lifestyle is precisely the cognitive trap that makes people poor. Lifestyles adjust. Kids adapt. Houses downsize. What doesn't adjust easily is the sunk cost fallacy that keeps people trapped in declining industries. Here's the deeper insight that the article is circling around, but not explicitly stating. We're at an inflection point where professional skills are becoming more valuable than domain expertise. For 30 years, the path to wealth was go to college, specialize in a valuable field, accumulate domain expertise, climb the ladder. That worked because those fields, finance, tech, law, medicine, were growing faster than the rest of the economy. But that's changing. AI is automating entry-level office work. Specialized domain knowledge is becoming commoditized. Meanwhile, blue-collar work, especially when wrapped in professional processes through private equity, is becoming high-skill, high-margin work. A person with marketing experience, project management training, and professional communication skills can move into home remodeling or construction and immediately bring value. A person with 20 years of carpentry experience but no project management training cannot move into that world as easily. The private equity-backed blue-collar companies have figured this out. They're not looking for people with trade experience. They're looking for people with professional skills who can learn the trade, because the professional skills are the differentiator. Now, let me extract the 3 timeless lessons. First lesson, sunk costs are not your constraint. Your constraint is the return on your marginal capital going forward. Every person making the decision that Justin Johnson is facing should do a simple calculation. What is the expected present value of staying in my current field versus switching? If the present value is higher in the new field, the past shouldn't matter. The college degree is already spent. The 5 years of experience is already gone. Those are gone whether you use them or not. The only question is which path produces better future returns. Second lesson, professional skills compound across domains. The mistake that white-collar workers make is thinking that their value is tied to their specialization. But the actual value is their ability to manage projects, communicate with stakeholders, maintain budgets, meet deadlines. Those skills are worth money in any industry. The software project manager can learn home remodeling faster than the master carpenter can learn to manage customer expectations. So the color doesn't matter. The ability to execute with professionalism matters. Third lesson, scale and growth create opportunity velocity. Crash Champions went from 13 locations to 650. That growth demanded management. It created promotions. It pulled people up through the organization. Compare that to a traditional slow-growth trade business where you grind for 20 years before you see 6 figures. The private equity playbook of buy, professionalize, scale is creating more rapid returns to people with professional skills than slow-growth markets ever could. This is why Gen Z is choosing blue-collar careers. Not because they suddenly love carpentry, but because they see the trajectory actually going. We have a mismatch. White-collar workers are unemployed, applying to hundreds of jobs, feeling stuck. Blue-collar jobs are desperate for labor and offering 6-figure paths. And the reason the mismatch isn't being cleared by the market is that white-collar workers are trapped by status. by sunk costs, by accustomed to a certain lifestyle. From a pure capital allocation perspective, they're making suboptimal decisions. They're choosing zero income and status over lower income and opportunity. That's the worst trade in finance, sacrificing real dollars for fake status. But from a psychological perspective, it's completely understandable. You went to college. You were promised a certain future. That future was supposed to be better than the alternative. The idea of stepping back into blue-collar work feels like breaking a contract with your own past. Except the contract was broken by the market, not by you. And the sooner you recognize that, the sooner you can optimize for the future instead of defending the past. The article's final line captures this. Career changes are never easy, but this is no time to let status and labels get in the way of the right long-term move. That's not a career advice platitude. That's a reminder that economic circumstances change, that the path that worked for the previous generation doesn't work anymore, and that the ability to adapt to accept a short-term step back for a long-term gain is the actual skill that creates wealth. Gen Z figured it out. They're choosing the blue-collar path at 5 times the rate of their older siblings. The question is whether white-collar workers with families and mortgages will have the courage and flexibility to follow. In 25 years, the workplace will likely be unrecognizable. That's what 5 workplace experts are saying. And they're not hedge betting or hedging their language. They're saying it clearly. The corporate structure we have today will not exist in 2050. Here's the single most important line from all of them, and it comes from Alan Guarino, Vice Chairman and CEO of Board Services at Korn Ferry. The middle layers of management, so central to today's corporate structure, could be a vestige of the past. A vestige. That means a trace, a leftover, a relic. The management layer that you've spent 20 years climbing, the structure that defines corporate life, the hierarchy that makes you a somebody instead of a nobody, that could be gone. This is important for investors because it challenges every assumption about how companies will be organized, how they'll allocate capital, and where human value will be captured. If middle management is gone in 25 years, then the path to wealth that generation after generation has followed. Climb the ladder, become a manager, get the promotion. That path evaporates. The Wall Street Journal brought together 5 experts to discuss the future of work. And what they're describing is not incremental change, it's structural transformation driven by AI, by workforce demographics, and by the fundamental economic question, what are humans for when machines can think? Let me walk through what each expert is actually saying, because the implications are enormous. First, Alan Guarino. He says, yes, there will be tasks and entire jobs taken over by AI, but we will all be elevated to a whole new superpower to make critical and creative decisions. That sounds optimistic. Elevated. Superpower. But think about what he's saying underneath. If AI takes entire jobs, what jobs are those? Entry-level jobs, junior analyst jobs, associate jobs, roles where you're doing repeatable, learnable work, the jobs that have been the entry point for people trying to build a career. Then he says middle management could be a vestige. Why? Because if AI is doing the execution and people are making the creative decisions, then the people whose job is to coordinate the executors, the middle managers, aren't needed anymore. The people at the top make strategic decisions. AI executes. No need for a middle layer to coordinate. And then here's the kicker. The role of the leader, too, will change, as they directly oversee a collaboration of people and intelligent systems. Leaders now manage AIs and people together. The job of leadership is no longer managing people. It's managing the mix of human and machine intelligence. What gets valued in that world? Emotional intelligence, empathy with tech savvy. Those are the leaders who shape the future. Not the analytical experts, not the specialists, not the people who climb the ladder by mastering a domain, the people who blend human judgment with AI capability. Next, Ravin Jesathasan from Mercer. He makes a point that should terrify every large corporation and delight every independent operator. Democratized access to AI will power the gig economy. Here's the specific insight. A Microsoft client is locked into MS Copilot because they need to realize a return on their license fees. A gig worker, a freelancer, a contractor has access to the full suite of tools from OpenAI, Google, and Anthropic. They can use the best tool for each job. So the gig worker has better technology than the corporate employee. The gig worker has more flexibility. The gig worker has access to more powerful capabilities. This will result in greater value being delivered by gig workers than ever before. Think about the capital allocation implications. If you're a company and your internal employees have access to MS Copilot, but contractors you hire have access to the entire AI ecosystem, you should be hiring more contractors. You should be shrinking headcount. You should be moving toward a gig and project-based model. That's not a trend. That's a convergence. That's an inevitable outcome of the technology landscape. Third, Gaurav Gupta from Qatar International. He says the nature of work will shift toward generalist roles. Generalists who can make connections, work across organizational silos, demonstrate creativity in problem solving. At the same time, there will be reduction in strategic planning, operational planning, and analytics roles. New roles will emerge in scenario modeling and change activation. Companies will invest in building leadership capabilities broadly across all employees. What's he saying? Specialists get replaced by analytics AI. Generalists who can connect insights and drive action become more valuable. The organizational structure flattens. Instead of a handful of people at the top and many specialists below them, you get more distributed leadership. Fourth, Peter Fasolo from Boston University and formerly J&J, he focuses on the demographic crisis. There will be fewer available workers in Europe, Japan, and the US. Over the next 25 years, fewer young adults available for colleges. Profound demographic shift. The implications: more investment in vocational and trade schools, skill-based training rather than pedigree-based training. Companies will become classrooms. The relationship between companies and workers shifts from transactional, you work for us, we pay you, to investment-based. We invest in your skills so you can be competitive in your domain. That's a massive shift in capital allocation. Instead of hiring fully formed workers, you hire raw talent and invest in training them. That makes sense in a shrinking labor market. You can't find enough ready-made talent, so you build it. Fifth, Tara Weiss on data and performance measurement. AI will give us real-time signals across the employee experience. Instead of annual reviews and sentiment surveys, we'll know hour to hour how someone is working, who they're collaborating with, what their natural rhythm is. Imagine an AI system that knows a salesperson does her best work from 3:15 p.m. to 7 p.m. in New York, while a teammate in Portugal performs best during complementary hours. The AI aligns workflows around each person's natural rhythm. This is radical transparency, and it has implications both good and bad. Good: you can structure work around how humans actually perform best. Bad: there's nowhere to hide. There's no credit stealing or credit dodging. Your actual output, your actual impact, is measured and visible. Now, let me show you what this means on screen. Imagine an organizational chart from 2026. It's roughly triangular. A few executives at the top, a thick layer of middle management, a base of individual contributors. Now imagine the same org chart in 2050. It's flatter. The executives are still there, but the middle layer has shrunk. Some of it has been replaced by AI. Some of it has been pushed down. What was a middle management decision is now made by an individual with better data and AI tools. And the base of individual contributors has gotten smaller as AI handles routine execution, but the remaining people are more senior, more generalist, more able to make decisions. It doesn't look like the org charts companies are using today. And companies that don't restructure toward this model will find themselves at a competitive disadvantage. Now let's talk about the capital allocation implications. Companies are currently optimizing for a world that's disappearing. They're investing in middle management training. They're building management tiers. They're creating specialist roles that pay premium salaries. They're hiring young people into entry-level roles, where AI is now doing the work. In the next 25 years, they need to invest in AI governance and integration generalist talent. With breadth and creativity, leadership development across the organization, not just at the top skills-based training and apprenticeships, gig worker integration and contractor management systems. The companies that see this shift coming and invest accordingly will win. The companies that keep investing in the org structure of 2000 will lose talent, lose efficiency, and eventually lose money. There's also a personal capital allocation question. Where should you invest your own human capital? If you're a specialist, you're competing with AI for that specialization. An analyst who specializes in financial modeling is competing with tools that do financial modeling faster and more accurately than any human. that person's value is declining. If you're a generalist who can connect insights from multiple domains, who can translate between AI outputs and human judgment, who can drive change, that person's value is increasing. You're becoming complementary to AI rather than substitutable by it. If you're in middle management right now, the question is, what would I be doing if my management layer didn't exist? Can I do that? Can I develop those skills? Because if you can't, you're in a declining category. Now, here are the 3 timeless lessons about technological disruption. First lesson: disruption always creates structural unemployment before it creates structural opportunity. The people whose jobs disappear, entry-level analysts, operational planners, some middle managers, they face real pain. Training takes time. Job searches take time. The fact that new opportunities will emerge in 5 or 10 years doesn't help someone who loses their job today. This is why generational shifts are so dramatic. The older generation bears the cost, the younger generation benefits from the new structure. Second lesson: democratization of tools inverts power dynamics. When AI tools were expensive and locked behind corporations, corporate employees had power over freelancers. Now that AI tools are democratized and cheaper outside of corporations, freelancers have power over corporate employees. This happens every time technology becomes accessible. The organization that controls the technology holds the power until the technology is democratized. Then the power shifts. Third lesson: when the cost of coordination falls, you need fewer coordinators. Middle management's core function is coordination. They coordinate between executives and workers, between departments, between levels. When AI can do that coordination better and cheaper, middle management becomes unnecessary. This isn't new. It's what happened when email replaced the need for administrative assistants to coordinate meetings. But AI is orders of magnitude more powerful at coordination than email was. So here's what the future looks like. In 2050, the corporation is flatter. There are no entry-level jobs. AI does that. There is no middle management layer. AI coordinates. There are executives who set direction, generalists who solve problems and drive change, and contractors who handle specialized tasks as needed. Careers look different. You don't climb a ladder. You build capabilities. You move sideways as often as you move up. You manage projects, not people. You collaborate with AI as often as you collaborate with humans. The workforce is smaller because there are fewer people working. But those people are older on average because people work longer. And those people have different skills: more leadership, more creativity, more judgment. Companies are organized around outcomes, not roles. You don't have a title that says senior analyst. You're a problem solver on the supply chain optimization team. You're evaluated on impact, not activity. And the one sentence to remember is this: the corporate ladder you're climbing is disappearing, and you should be asking yourself whether you're training for the building that's replacing it. In 2020 and 2021, during the peak of a massive trend, 21 public company CEOs were given equity awards valued at over $100 million each. 9 figures. The total value of these awards was $5.6 billion. The average award was $268 million per CEO. The logic was clear. These were moonshot packages. Swing for the fences compensation. Huge upside if the CEO delivered huge returns. The idea came after Tesla awarded Elon Musk billions of dollars in stock options in 2018. If you promise a CEO the moon, the logic went, you'll get out-of-this-world results. Here's what actually happened. The analysis by Equilar found that shareholder returns trailed the S&P 500 at 3/4 of the 20 companies. Half the CEOs forfeited much or all of their stock awards. Just 4 out of 21 met all their targets. And where performance is still being measured, the average CEO has earned only about 1/4 of the total award. This is a $5.6 billion lesson in why incentive alignment is harder than it sounds, why setting performance targets is extraordinarily difficult, and why copying the Elon Musk playbook is a guaranteed way to destroy shareholder value. Let me walk through the numbers and the names because the data is brutal. The chart you're looking at shows stock returns for each company that made a moonshot pay package versus the S&P 500. The S&P line is there as the baseline, what you would have gotten if you just invested in an index fund and did nothing. Picture a series of bars, some green, showing companies that beat the index, most red showing companies that lost to the index. CrowdStrike's George Kurtz, Regeneron's Leonard Schleifer, KKR's two co-CEOs. These are the winners. They're in green, showing returns that beat or kept pace with the S&P. The rest? Red. Most of them significantly below the index. CrowdStrike's George Kurtz. His 2021 Moonshot package has done well. The company is up significantly from the grant date. RH's Gary Friedman. Up. But then look at the losses. Rivian's RJ Scary. Way down. Roblox's David Bezuki. Down. Robinhood's Vladimir Tenev. Down. DoorDash's Tony Xu. Down. Affirm's Max Levchin. Down. Most of these companies said, "We'll give you a massive equity award if you hit these ambitious targets. We're betting you're a genius who can move mountains." What happened instead is they didn't move mountains. The companies didn't grow the way the boards expected. The stock prices didn't soar. And the CEOs left with either nothing or a fraction of what they were promised. Now let's look at the specific case that makes this real. Jeff Green at Trade Desk. Jeff Green received a 2021 stock option award valued at $819 million. The potential payoff was staggering. If Trade Desk's share price passed $340 by October 2031, the award could balloon to more than $5.2 billion. That's right, $5.2 billion. Not revenue, not earnings, stock price. The board was saying, if you can grow this company hard enough that the stock hits 340, you get $5 billion. What actually happened? Trade Desk shares closed Friday at a little over $35. 35, not 340. The options have unlocked only a quarter of the award, valued at about $16.3 million as of December. That's down from around $224 million when the award was made. Jeff Green hasn't failed. Trade Desk is a real company in the digital advertising business. But the board set a goal so aggressive, stock price going from 35 to 340 in a decade, that it was almost certainly impossible from day one. It's not a motivating goal. It's a fantasy goal. And the CEO gets paid almost nothing because the fantasy didn't come true. Now let's contrast that with the four winners, Scott Nuttall and Joseph Bay at KKR. These two co-CEOs hit all their targets. Their combined awards were valued at $2.6 billion. The stock is up, the metrics have been met, the private equity firm has delivered. Why did KKR work? KKR is in private equity. The targets are likely more measurable and more controllable than they are for a public company in a competitive market. You can set a target for fundraising. You can set a target for returns. You can measure fee growth. These are variables that the operators can influence. A CEO can't control the stock price of a company in a competitive market. A private equity partner can control how much capital they raise and how much return they generate. Leonard Schleifer at Regeneron. His 2020 Moonshot Award has performed well. The stock is up. The company has executed. Why? Regeneron is a biotech company with real products, real revenue, and growth driven by actual drug sales. The targets are likely tied to things the company can control: clinical trial success, FDA approvals, revenue targets. Again, more concrete than hit a stock price. George Kurtz at CrowdStrike. His 2021 award has performed. The company is in cybersecurity, a growing market with real products and real customers. The targets are likely tied to revenue and profitability metrics. Again, more controllable. Do you see the pattern? The winners are in businesses where the targets are measurable and within the company's control. The underlying business has actual growth metrics. The CEO's performance is directly tied to real outcomes. The losers are in businesses where the targets are dependent on stock price movements influenced by markets. The underlying business is harder to control. The CEO's performance is dependent on variables outside their control. This is the core lesson from Andrew Gordon at Equilar. A few of them worked out, a few didn't really have very good guardrails and earned way too quickly. You don't want to set goals too easy or too difficult. It's really hard to predict. That's the truth. You don't want goals too easy or too difficult. But when you're writing a $500 million paycheck, getting that balance right is extraordinarily hard. Now let's talk about why this happened. In 2018, Elon Musk got billions of options. Tesla's stock soared. Elon got rich. Investors got rich. The narrative became, if you promise the CEO the moon, you get out of this world results. So in 2020 and 2021, dozens of boards looked at the Elon example and said, we need to do that. They hired consultants. They structured moonshot packages. They set ambitious targets. What they didn't understand is that Elon's success was not repeatable. Tesla was in an emerging market. Electric vehicles, the company had a founder CEO with unique vision and technical insight. The targets were aggressive, but within a company Elon actually controlled. And the timing was perfect. The market shifted toward EVs right as the package vested. Most of the boards copying the model were in mature competitive industries, with CEOs who were talented operators but not visionary founders, setting targets based on hope rather than analysis, ignoring the fact that stock price is not fully controllable by the CEO. The capital allocation failure is this. The board spent $5.6 billion in aggregate trying to incentivize performance that didn't happen. That money could have been returned to shareholders via buybacks, dividends, or capital investments. Instead, it was deployed as a bet on moonshot performance and largely lost. The second capital story in this article is data centers, which actually deserves more attention than it gets. Commercial real estate construction is poised for little or no growth in 2026. Higher interest rates, steeper material prices, tight labor force. All headwinds. Spending to build offices, hotels, apartments, warehouses is projected to fall. But data centers are a bright spot. Construction of these properties is less deterred by higher costs because of unmet demand from hyperscalers. Amazon, Google, Oracle, they continue to finance billions of dollars of new AI-focused development. Jay Bowman from FMI said it clearly. The cash is not an issue for these people. That's the insight. While other real estate developers are squeezed by higher costs, data center developers are not. Amazon and Google are willing to pay for additional capacity because AI is their core business now. The builders can raise prices and still win projects. That's pricing power. That's the ability to compound capital. So, if you're a construction company, the question is, where are you allocating capital? Build offices and hotels that nobody wants? Or build data centers for hyperscalers who will pay premium prices? The answer is obvious. That's capital allocation responding to incentives. Now let me extract the 3 timeless lessons. First lesson, performance targets must be within the CEO's control. If you tie pay to variables the CEO can't influence, like stock price in a competitive market, you're not incentivizing performance. You're just gambling. The winners in this analysis had targets tied to revenue, fundraising, clinical outcomes, product metrics, things the organization could influence. The losers had targets that were dreams rather than achievable milestones. Second lesson, copying success from a unique founder doesn't work. Elon Musk's Moonshot package worked because Elon is a technical founder in a market going through structural change. Boards that copied the structure without understanding the unique circumstances inevitably failed. This is the problem with best practice benchmarking. You can copy the form but not the conditions that made the form work. Third lesson, when you can't set good targets, don't set huge stakes. Better to give a smaller award that the CEO will likely achieve than a huge award based on a fantasy. The smaller awards that were actually hit created more credibility and more shareholder value than the huge awards that were missed. It's better to pay less for consistent overperformance than to pay more for missed targets. Now, here's the investment implication. Look at the boards of directors. They set these packages. They had consultants. They had data. They had comparative analysis, and 3/4 of them made the wrong decision. The incentive wasn't aligned to good outcomes. So when you're evaluating a company's management and compensation, ask yourself, are the targets within the CEO's control? Are they achievable but ambitious? Or are they moonshots that nobody believes in? If they're moonshots, the CEO might be getting rich, but the shareholders might be getting poor. That's a misaligned board. That's a company where capital allocation is not optimized. The real lesson from this data is not about the CEOs. It's about the boards that paid them. Boards that tried to copy a template that works in very specific circumstances and didn't stop to ask whether those circumstances applied. And the one sentence to remember is this: the $500 million bet that doesn't require delivery until a specific date is just a way of paying the CEO now and disappointing shareholders later. Commercial real estate construction is poised for little or no growth in 2026. Higher interest rates, steeper material prices, a tight labor force, all significant headwinds. Spending to build offices, hotels, apartments, warehouses is projected to fall. But data centers are a bright spot. In fact, data centers are the only bright spot. Construction of these properties is less deterred by higher costs because of unmet demand from hyperscalers. Amazon, Alphabet's Google, Oracle, they continue to finance billions of dollars of new AI-focused development. This tells you everything about where capital is actually flowing and why it matters. When 99% of the construction market is contracting and 1% is soaring, you're looking at an inflection point. You're looking at the market telling you where the future is. The Wall Street Journal reported on this, and the implications are enormous. Let me start with the macro picture. Non-residential building construction, offices, hotels, apartments, warehouses, all the traditional commercial real estate is projected to total $844.4 billion in 2026. That's an increase of 0.14% from 2025, essentially flat. But that number masks the underlying collapse. Accounting for inflation, that figure represents a decline in real terms. Real construction spending is falling. Higher interest rates have killed the financing model. Steeper material prices have killed the margins. A tight labor force has killed the ability to execute projects. Construction firms can't find enough workers. Even if they could, tariffs have driven up the cost of aluminum, steel, copper, and lumber. 40% of construction firms surveyed by the AGC said they raised their bid prices in response to tariffs last year. Only 11% absorbed the cost themselves. Projects because their costs are up, their labor is constrained, and their customers are hesitant because of higher interest rates. Now contrast that with data centers. Data center construction is projected to rise 23% in 2026 compared with the year prior. 23%. In a market that's flat to down, data centers are soaring. This isn't accidental. This is driven by hyperscalers. Amazon, Google, Oracle, Microsoft. These companies are betting the farm on AI. They need compute capacity. They need it fast. They need data centers to power their large language models, their AI platforms, their inference engines. And they're willing to pay top dollar for it. Jay Bowman from FMI said it clearly. The cash is not an issue for these people. That's the insight. For hyperscalers, cash is not the constraint. Availability of construction is the constraint. They want to spend billions more, but they can't because there's a limited pool of construction firms that can build data centers. So, they compete on price. They pay premium rates. They accelerate timelines. They do whatever it takes to get capacity. This inverts the entire power dynamic in construction. Usually, the customer has power. They bid out projects, drive prices down. But with data centers and hyperscalers, the customer is desperate. They're willing to pay. The construction firms have pricing power. Now let me show you the data on screen. You're looking at real, private, non-residential fixed investment over time. It's an index. In 2020, it's at 100. Track forward to 2021, 2022, 2023, 2024, 2025, the overall trend line, everything except data centers, stays flat or declines. Structures excluding data centers barely budge since 2020. But data centers? There's a steep upward trajectory, starting from nothing, rocketing up. By 22,000, data centers are clearly diverging from the rest of the market. By 2026, the divergence will be dramatic. Below that, you see a bar chart. Projected annual change in construction spending for 2026. Warehouses, down. Traditional offices, down. Apartments, down. Hotels, down. Data centers, up 23%. One bar going up, everything else going down. That's not a normal market. That's a capital reallocation happening in real time. Here's why data centers are so expensive and so capital intensive. Andy Halleck is president of Skender, a construction company in Chicago. He explained, data centers can cost more than $1 billion to build and employ thousands of workers on the construction site. By contrast, Skender's other large-scale commercial real estate projects usually cost hundreds of millions of dollars and employ hundreds of workers. $1 billion versus hundreds of millions. Why the difference? Electrical infrastructure. Data centers need power substations, generators, electrical infrastructure that doubles the size of the project. A data center that might be 500,000 square feet of physical building needs as much electrical infrastructure as another 500,000 square feet of physical space. Halleck said it directly, The infrastructure requirements, in essence, more than double the size. So a data center costs more than $1 billion and employs thousands of construction workers. In a tight labor market, that's significant. It means data center projects are absorbing labor from the rest of the market. They're paying top dollar, attracting the best crews, and pulling them away from other projects. This is capital allocation in real time. Traditional real estate developers can't compete for labor at those prices, so their projects get delayed or shelved. Data center developers pay whatever it takes. Now let's talk about the constraints on data center growth itself. Michael Guckus is chief economist at Construct Connect, a data and software firm. He said, once you literally have every contractor within a state and every surrounding state who's available getting paid top dollar for this stuff, you just can't move physically any faster. That's the constraint. It's not money, it's labor. You could give a data center project unlimited budget and you still can't accelerate it beyond the physical capacity of the labor market to execute it. This is why hyperscalers are so worried. They want to build more data centers. They have the cash. They have the demand for AI capacity. But they're bottlenecked by construction labor. The skilled electricians, the steel workers, the concrete specialists, they're all booked on data center projects. There's no spare capacity. And now immigration enforcement is making it worse. According to a survey of more than 900 construction companies by the Associated General Contractors of America, 1/3 said their operations were affected by immigration enforcement actions in the past 6 months. Nearly 1/4 said their subcontractors lost employees as a result of immigration enforcement. Large construction firms with annual revenue of $500 million or more were the most likely to report enforcement impacts. So you have tight labor from tariffs and interest rates. Then you add immigration enforcement. It's a perfect storm. The construction labor pool is shrinking. Wages are rising. Data centers are paying top dollar for whatever labor is available. This creates a two-tier market. Tier 1. Data centers with unlimited capital, willing to pay premium wages, competing fiercely for skilled labor. Tier 2. Everything else. Traditional real estate, warehouses, apartments. These projects are getting starved of labor because the labor is flowing to data centers. Steve Stouthammer, an executive at Skanska USA Building, said, price increases from tariffs have hit especially hard for products made from aluminum, steel, copper, and lumber when they cannot be sourced domestically. These materials are needed in data centers. The data centers pay the tariff costs. Other projects can't absorb them, so those projects get delayed or canceled. Now let's do a capital allocation autopsy. What should a construction company do in this environment? Option 1. Compete for traditional real estate projects. Tight margins, squeezed labor, rising material costs, falling demand. You can work, but you won't make money. Option 2. Pivot to data center construction. Larger projects, premium pricing, unlimited customer budgets, less price sensitivity. For a rational construction firm, the choice is obvious. You reallocate your best teams to data center work. You let traditional real estate slide. You follow the capital. This is what's happening. Data center construction is soaring. Everything else is contracting. Not because traditional real estate suddenly became bad, but because data center work became so profitable that it's pulling resources away from everything else. The hyperscalers, Amazon, Google, Oracle, they have decided that AI is the center of their businesses. They're deploying billions in CapEx toward compute capacity. That CapEx flows to construction firms who bid for data center work at premium margins. Construction firms reallocate labor from traditional projects to data center projects. Traditional real estate gets starved of labor. It's a cascade of capital reallocation driven by one decision: hyperscalers betting heavily on AI. This matters because it tells you what the market actually believes about the future. It's not talking, it's spending. And it's spending on data centers. That means the market believes AI infrastructure is the future. Not offices, not apartments, not hotels. Data centers. Now here's what's interesting. Data centers are only projected to be 6% of all non-residential building construction in 2026, up from 2% in 2023. That's a tripling of share in 3 years. And the trajectory is steep. If that continues, if data center construction keeps accelerating while everything else contracts, we could see data centers become 10, 15, 20% of non-residential building within 5 years. That's a fundamental reshaping of the construction market. And it all flows from one thing: Hyperscalers deploying capital toward AI infrastructure. Now let me extract the 3 timeless lessons. First lesson. When capital is unlimited for one category and scarce for others, you'll see rapid reallocation of all resources toward that category. Hyperscalers have unlimited capital for data centers. Everything else is constrained, so labor, materials, attention, project schedules, they all flow toward data centers. This isn't a mistake, it's the market working. But it has brutal second-order effects on the rest of the economy. Traditional construction gets starved. Small developers can't compete for labor at data center wages. The market bifurcates. Second lesson, bottlenecks move. When capital is unlimited but labor is scarce, labor becomes the constraint. You can build faster if you have money, but you can't build faster than your labor pool will allow. Data center projects are hitting that wall now. They're paying premium wages, but they still can't go faster than the labor market will support. This means the real constraint is no longer capital. It's the ability to physically execute projects with available workers. Third lesson, inflection points show up in capital allocation first. The WSJ article doesn't say AI is important, but the construction market does. The construction market is screaming that AI infrastructure is the future. Offices are dying. Apartments are struggling. Data centers are booming. An investor can see this in the data, which sectors are growing, which are shrinking. Follow the capital. Follow the construction starts. Follow the labor flows. They'll tell you what the market actually believes about the future. So, here's what I'm convinced of. We're in the middle of a structural shift in capital allocation. Hyperscalers are betting the farm on AI. That means data center construction will stay elevated for years. It will pull resources away from traditional real estate. It will create labor shortages and wage inflation in construction. And it will reshape the entire real estate market. For investors, the question is, who benefits? Construction firms that can execute data center work benefit. Electrical contractors benefit. Suppliers of electrical infrastructure benefit. Property owners who lease to hyperscalers benefit. Everybody else gets squeezed. The construction market is screaming an answer to the question, where is capital actually flowing? And the answer is data centers. Everything else is secondary. And the one sentence to remember is this. When 99% of the market is contracting and 1% is soaring, the 1% is telling you where the future is going to be. Nearly a decade ago, Walmart identified Homegoods as an area for improvement. The company also saw that its selection was dowdy and uninspiring. The retailer had a problem. Its Homegoods department looked cheap, felt cheap, and sold cheap. Walmart had built its entire brand on everyday low prices. But in Homegoods, that strategy was destroying margins and losing customers to Amazon. This is the story from the Wall Street Journal, and it's a masterclass in capital reallocation and brand repositioning under pressure. Let me start with the data that shows the crisis. As of last fall, Amazon's share of the U.S. furniture and home furnishings market hit 20%, more than double its 9% share in 2019. In just 6 years, Amazon doubled its market share. Meanwhile, Walmart's share of the category fell to 7%, down from 9.3%. Walmart lost share while Amazon more than doubled theirs. The picture on screen would show the divergence. Amazon's line going up sharply, Walmart's line going down. The category was growing, but all of that growth went to Amazon. Walmart was losing its position. This matters because Walmart's grocery business is the core of the company. It draws hundreds of billions in revenue. But grocery margins are tight. The company needs to grow beyond its core, low and middle-income shoppers. It needs higher-income customers. It needs higher-margin categories. And Homegoods is the obvious target. It's where people spend when they have disposable income. It's where margins are better than groceries. But Walmart has been failing in Homegoods for years while Amazon captured the category. Now, here's the fascinating part. Walmart's strategy to fix it. Years ago, the Homegoods team at Walmart was focused on improving the quality of products and bringing in well-known brands. But there was a problem. At the time, many brands felt Walmart was too down market to house their goods. They didn't want to associate with Walmart. The discount positioning was a liability. So Walmart took a different approach. It focused on simple, trendy items at accessible price points. And it zeroed in on candles as a way in. Candles were also more profitable than other home decor like wall art. That was Jeff Evans, a former Walmart executive who led the home category from 2017 to 2020, talking about the strategy. The insight is brilliant. Candles are expensive relative to their cost. A $20 candle costs the retailer maybe $5. That's a 400% markup. Walmart at the same price point might cost $12 to the retailer, so margins are 60% better on candles. In 2017, they put highly scented Yankee candles on Walmart shelves for the first time. This was a big deal. Yankee Candles is a premium brand. It was a signal to consumers. Walmart is not just cheap anymore. Walmart carries brands you actually want. Sales started to rise. The signal worked. By the end of 2020, Walmart embraced several new brand partnerships. After years of wooing, Nespresso, the coffee maker brand, started selling through Walmart. That's premium positioning. Nespresso in Walmart. That's a credibility shift. But here's where Walmart made a strategic mistake that it had to correct. Walmart had too much product in the lowest price range, while most shoppers bought in the mid-range of quality and price. The company optimized for the bottom of the market when most shoppers were in the middle. So the product selection didn't match where the money was. Then came Beautiful by Drew Barrymore. Drew Barrymore and Shay Hong, the founder of Made by Gather, decided to pitch Walmart a new line of colorful air fryers and toasters called Beautiful. Barrymore said something interesting. I went to Walmart because other people weren't. That's the insight. Premium founders and brands were avoiding Walmart. So Barrymore went there and owned the space. When Beautiful products hit Walmart stores, they were a massive hit. The Sage Green air fryer sold out within the first 24 hours. The stand mixers were a top seller last year. 15% of Beautiful brand shoppers are new to Walmart. 15%. That's customer acquisition. That's the proof that the brand repositioning is working. Now let's look at the prices on screen. You're seeing specific items Walmart is now carrying and their prices. An ochre velvet swivel chair for $238, a $1,699 DeLonghi espresso machine, a $79 lavender crock pot. These are expensive items. These are premium prices. This is Walmart moving up the value chain in home goods. Creighton Kuiper is the executive who runs the home category for Walmart in the US. He said something that captures the entire strategy. If you are going to spend $8 on a towel, it doesn't just need to be a black or navy or white towel. We've realized that everybody wants a beautiful home. That's the insight. Walmart's internal research shows that shoppers equate stylish designs with better quality. They don't just want function. They want aesthetics. They want their home to look good. And they'll pay for that. So the strategy is, keep the everyday low prices mandate, but make sure the cheap stuff looks good. The $8 towel doesn't have to be black or white. It can be colors that match interior design trends. It can feel premium, even though it's inexpensive. This is the capital allocation shift. Walmart is investing in designer brand partnerships, curated product selections, premium aesthetic positioning, higher income customer targeting. But it's also creating a problem for its own store brands. Walmart invested in the design of some of its own store brands, like inexpensive Mainstay and mid-range Better Homes and Gardens. These store brands are now challenging the partner brands like Beautiful. Walmart is competing with itself. It's cannibalizing the Beautiful brand that it just spent capital to acquire. Not everything has worked. There was a 2021 partnership with Gap to sell Homegoods from the apparel retailer. That ended recently after sales faltered. Gap's Homegoods didn't resonate at Walmart. The brand association didn't work. More design-forward brands are coming. Home decor and furniture are the current standouts. Walmart is gradually getting more premium brands to sell on its shelves. DeLonghi espresso machines last year. More European premium brands coming. Now let me do the capital allocation autopsy. What was Walmart expecting? They expected that premium brand partnerships plus better design would attract higher income shoppers and increase margins. The investment was in product curation, brand partnerships, and inventory management. What actually happened? Beautiful was a hit. Customers responded. But Walmart's own store brands are now competing with the premium partners. The company is cannibalizing its own premium positioning by launching better designed Mainstay and Better Homes and Gardens lines. The opportunity cost? The capital spent on Beautiful and DeLonghi and Nespresso partnerships could have been spent on expanding Amazon's competition in a different way, or it could have been spent on grocery margin improvement or supply chain optimization. The hidden trade-off? By investing in premium home goods, Walmart is abandoning the lowest-income consumers who made Walmart what it is. The company is saying, we're moving up market. That means less inventory for the price-sensitive customer. Less focus on the volume game, more focus on the margin game. This is the fundamental risk. Walmart's entire brand is built on serving the price-conscious customer. That customer still exists. That customer is their most loyal cohort. By repositioning toward premium, Walmart is risking that loyalty. But the math is clear. Grocery is low margin. Home goods are higher margin. Amazon is capturing the upmarket home goods customer. Walmart needs that customer. So the shift is inevitable. Now let's contextualize this in the larger Walmart versus Amazon war. In 2000, Amazon could overtake Walmart as the country's biggest company by revenue. In the first 9 months of 2025, Walmart reported $500 and $202.5 billion in revenue. Amazon's was $503 billion. Amazon is closing the gap fast. Amazon remains the e-commerce titan, capturing $2 of every 5 spent online. And Amazon is growing particularly fast in non-grocery goods, thanks to speedy shipping and broad selection. So Walmart is facing 2 pressures. First, Amazon is overtaking it in overall revenue. Second, Amazon is dominating categories like furniture and home furnishings, where Walmart should have strength. The home goods repositioning is a response to both pressures. If Walmart can grow home goods margins and capture high-income customers, the company can improve profitability even if Amazon captures volume. But here's the uncomfortable truth. Walmart is trying to be something it's not. Walmart is the low-price leader. That's the brand. That's the competitive advantage. That's what built $500 billion in revenue. Now Walmart is trying to also be a premium home goods curator. That's a different brand. That's a different set of capabilities. That's a different customer relationship. Can one company be both? Can Walmart be the low-price leader for groceries and the premium home goods curator for affluent customers? History suggests the answer is no. Companies that try to serve multiple positioning end up confusing customers and failing at both. But Walmart is trying anyway, because the only alternative is to concede home goods to Amazon and accept a slower growth trajectory. Now let me extract the 3 timeless lessons. First lesson: margin pressure forces repositioning. Walmart's grocery business is the core, but margins are tight, so the company must move upmarket into categories with better margins. That's a sound capital allocation decision, but it forces a brand repositioning that risks confusing the core customer. You can't be the everyday low-price leader and the premium curator simultaneously without creating cognitive dissonance. Second lesson: premium brands are a channel to market repositioning. Walmart couldn't reposition itself to affluent customers just by changing its messaging. Affluent customers had years of conditioning. Walmart is for poor people. Walmart is down market. But partnering with premium brands like Nespresso, DeLonghi, and Beautiful gives Walmart credibility with affluent customers. The brand association does the work. Walmart doesn't have to convince customers. Nespresso does. That's smart capital deployment. Third lesson: when you succeed at brand repositioning, you have to resist cannibalizing with your own store brands. Walmart's Better Homes and Gardens line is now competing with Beautiful. The company is creating a prisoner's dilemma for itself. If it makes the store brand too good, it competes with the premium partner brands and loses those partnerships. If it keeps the store brand weak, it wastes the opportunity to capture margin. Here's what I'm convinced of. Walmart will succeed at home goods repositioning because the market demand is real and Amazon's dominance is vulnerable. Customers do prefer shopping on Amazon for convenience, but many would also shop at Walmart if the products were available. By stocking premium home goods at Walmart, the company is creating a new reason to visit. That's valuable. But the long-term risk is real. Walmart's brand positioning becomes confused. Is it the low-price leader or the premium curator? Over time, that confusion could erode loyalty with both segments. Affluent customers might still prefer Amazon selection. Price-conscious customers might feel abandoned. The one sentence to remember is this: Walmart is trying to play 2 different games at once. The low-price volume game and the high-margin premium game, And the only way that works is if it succeeds at being invisible about the switch. Fox shares are up 42% over the past 12 months and recently hit record highs. The company did something that seemed insane at the time. It became smaller. It became more focused. It became more profitable. The Wall Street Journal reported on this strategy, and it's a masterclass in capital allocation, competitive positioning, and knowing what not to do when everyone else is doing it. Here's the core story. In 2019, Fox sold the major entertainment assets of 21st Century Fox for $71.3 billion. That was a massive, era-defining divestiture. The company got out of movies, got out of TV production, got out of the long-tail legacy entertainment business. And with that capital decision, Fox fundamentally changed what it was. John Nallen is the president and chief operating officer of Fox Corp. He said it directly. Companies that have owned the long-tail legacy entertainment channels have been the ones that have been the most challenged. That's the insight. The legacy entertainment business, ABC, NBC, CBS, with their cable channels, all struggled. Why? Because streaming disrupted the entire model. Netflix stole content. Netflix stole audiences. Netflix killed the syndication game. But Fox made a different bet. Fox said, we're going to own the platforms where people gather live. Cable news, live sports, audiences that must be consumed in real time, not on demand. So Fox focused its core cable news business and invested in live sports. The NFL, Major League Baseball, and the acquisition of 1/3 of Penske Entertainment, which owns the IndyCar Series and Indianapolis Motor Speedway. Live content, real-time audiences. That's the structural advantage Fox identified. Now let's contrast this with what every other media company did. While rivals plowed billions into direct-to-consumer streaming offerings, Fox largely steered clear as the market found its footing. Disney Plus lost billions. Paramount Plus lost billions. Warner Bros. Discovery lost billions. Every traditional media company except Fox went all in on streaming. Fox News in 2018 launched Fox Nation, which intended to complement the network's offerings with programming like The Saints, a docudrama narrated by Martin Scorsese. It was a toe dip into streaming, not a bet. The company also created a direct-to-consumer product called Fox One last year. But here's what Rob Wade, Fox Entertainment's chief executive, said about streaming. Streaming services are beasts which require to be fed. We haven't had that distraction. That's the capital allocation insight. Streaming is a beast. It requires constant feeding. It requires content investment. It requires marketing spend. It requires subscriber acquisition and retention mechanics. It's a black hole for cash. Fox looked at that and said, no thanks. We're going to focus on what we have. Cable news, live sports, audiences that can't be replicated by Netflix because Netflix can't offer live, real-time content. Now let's look at the data on screen. Cable news primetime ratings by quarter from 2010 to 2025. You're seeing a line chart. Fox News is the top line. It's rising steadily. In 2022, it's around 2.5 million viewers. By 2025, it's up to around 3 million. That's growth in a declining cable news market. Below Fox News, you see CNN declining, MSNBC declining, Newsmax at the bottom, flat. Fox News is the only one growing. And it's not growing slowly. It's growing consistently. Why? Because cable news is where live audiences congregate. During elections, during crises, during breaking news. People want real-time information. They want analysis as events happen. You can't pause cable news. You can't skip ahead. It's live. That's the structural advantage. That's why Fox News has a moat. That's why Fox News attracts audiences. Now let's talk about advertisers. A few years ago, major brands pulled their ads from Fox News. Controversial remarks made by show hosts Laura Ingraham and Tucker Carlson caused boycotts. Advertisers were afraid of brand association with controversial content. That changed. Last year, Fox News attracted hundreds of new national advertisers. Ace Hardware, MSC Cruises, Lavazza Coffee, Unilever. These big national brands returned to Fox News after not appearing for years. Mark Penn is the CEO of ad firm Stagwell. He said something important. Brands' aversion to advertising alongside hard news writ large is beginning to thaw. Mark Penn has partnered with media publishers, including the Wall Street Journal, the New York Times, and the Washington Post on studies debunking the idea that having ads appear near news stories harms brands. That's critical. The whole advertiser exodus from cable news was based on a false premise. Advertisers thought ads near hard news would hurt their brand, but research showed that wasn't true. In fact, being associated with serious journalism gave brands credibility. So advertisers came back. Stagwell increased spending on Fox News by about 19% in 2025 compared with the prior year, more than it did across all TV and online news. Why? Some ad buyers say clients advertise on Fox News to speak directly to President Trump, who frequently watches. Many companies are touting investments in American production or contributions to the U.S. economy. The network allows brands to reach people in the middle of the country. Fox News attracted hundreds of new national advertisers, and the network saw its highest ratings yet in a non-election year. Dave Campanelli is the president of global investment for Horizon Media, an ad buying firm. He said, "Outside of sports, it is so hard to get any kind of mass audience in cable. That's the scarcity. In cable TV, where audiences are fragmented, the only way to get mass audiences is sports or cable news. And Fox has both." Now let's talk about the risks. Like its competitors, Fox is dealing with the rising price of valuable live sports. The National Football League has the right to opt out of its agreement with Fox at the end of 2029. Nallen said Fox is committed to keeping those rights. Michael Mathinson, an industry analyst, said they have to do whatever they can to keep the NFL. That's the vulnerability. The NFL is the crown jewel. Losing the NFL to another network would be catastrophic. The NFL essentially funds Fox's entire portfolio because the rights attract audiences, attract advertisers, and anchor the business. But the NFL knows how valuable it is. Each new contract is worth billions more than the last. ESPN, Amazon Prime, Fox, NBC, they're all bidding. The price keeps going up. At some point, the revenue from advertising and affiliate fees won't justify the rights costs. Fox is betting that it can manage that math, that the live sports content will continue to attract premium advertising that covers the cost of the rights. Now let me do the capital allocation autopsy. What did Fox expect when it sold the entertainment assets? It expected to get out of a declining business and into a more defensible business. What actually happened? Fox got out of the streaming wars, while Disney, Paramount, and Warner Brothers were burning billions on Netflix competitors. Fox maintained profitability. Fox extracted cash from cable news and sports. Fox's stock went up 42%. The opportunity cost of staying out of streaming? The upside would have been to compete with Netflix, but Netflix won. No one else built a competitor that justified the investment. So Fox avoided a cash-losing proposition and instead focused on its core strength. The hidden trade-off? Fox is now a niche business. It's not a diversified media conglomerate. It's cable news and live sports. If something happens to those franchises, the company is vulnerable. But that's the bet Fox made. It said, "We're going to be the best at what we're good at, not mediocre at everything." Now let me extract the 3 timeless lessons. First lesson: live content has a permanent structural advantage in a world of on-demand platforms. Netflix can produce great drama. Netflix can produce documentaries. But Netflix can't do live. Netflix can't offer real-time events. So audiences that want live content, sports, news, breaking events, they will always come to linear TV. Fox identified that and built a business around it. Second lesson: sometimes the best capital allocation decision is not to do something. Everyone else went all in on streaming. Everyone else spent billions trying to compete with Netflix. Fox said, "We're not going to compete on Netflix's terms. We're going to compete on our terms." That decision saved billions in losses and allowed Fox to invest in what it actually had an advantage in. Third lesson: advertiser boycotts based on false premises can be overcome with research and time. The advertiser exodus from cable news was based on the belief that ads near hard news hurt brands. But research showed that wasn't true, so brands came back. Fox had the confidence to wait it out because it understood the data. It didn't panic and move up market or change its content to appease advertisers. Here's what I'm convinced of. Fox is in a stronger position than any other traditional media company because it owns the structural advantages of live distribution and mass audiences. As long as people want to watch live sports and cable news, Fox will have advertising value. That value will support the business even as other traditional media companies fade. The real risk is not competition from streaming or digital platforms. The real risk is that sports rights prices keep going up and eventually exceed what Fox can afford to pay. That's the vulnerability that keeps the CEO awake at night. That's the capital allocation problem Fox has to solve. But for now, Fox's bet on staying small and focused on live content is the best strategic positioning in traditional media. And the one sentence to remember is this: in a world of unlimited on-demand content, control of the one thing you can't pause, live events, is worth more than control of 1,000 streaming shows. This is Avi. Like and subscribe. On to the next.